What if I told you that a war brewing thousands of miles away could directly impact your wallet, making everything from gas to groceries more expensive? And what if that same conflict could also derail efforts to bring down interest rates, hitting your loans and credit cards harder? Well, that's exactly the complex economic storm brewing for the United States right now, thanks to the escalating situation with Iran. For months, we've seen glimmers of hope on the inflation front, but now a perfect storm of rising oil prices, shipping chaos in the Middle East, and some concerning signs in the U.S. job market are threatening to undo all that progress. We're talking about a real policy dilemma for the Federal Reserve, raising the specter of stagflation, that dreaded combination of higher prices and slowing economic growth. Let's break it down. Just last Friday, gas prices hit their highest point since September of 2024, with the national average climbing to $3.32 a gallon. Meanwhile, U.S. crude oil just logged its biggest weekly gain on record, data going back to 1983. This isn't just a bump, it's a clear signal that those pump prices could continue their upward march in the days and weeks ahead. Now, normally, when the labor market shows signs of weakening, which it is, the Federal Reserve would typically consider cutting interest rates. That's one of their main jobs, ensuring stable employment. But here's the twist. The Iran conflict is throwing a massive wrench into that plan. The surging oil prices and disruptions to global shipping threaten to supercharge energy costs across the board, potentially reigniting inflation, which is already hovering above the Fed's target of 2%. This leaves policymakers in a truly precarious position. As one economist put it, the recent economic reports and geopolitical events are complicating the Fed's job by raising risks on both sides of their mandate. On one hand, we're seeing fewer jobs created and a weaker labor market, signaling a slowdown in growth. On the other, the Middle East conflict is directly fueling inflation risks. Much of this risk hinges on the Strait of Hormuz, that critical narrow waterway along Iran's southern coast. Roughly 1/5 of the world's oil supply passes through there, along with essential commodities like aluminum and fertilizer. With over 80% of global trade moving by sea, any significant disruption in this choke point can send shockwaves through supply chains worldwide. We're talking slower shipping, higher freight costs, delayed raw materials, and ultimately increased production expenses for companies, costs that inevitably get passed on to you, the consumer. And the longer these disruptions persist, the more significant the impact on oil prices. Some experts are even warning that crude could climb above $100 a barrel if shipping remains heavily disrupted. To put that in perspective, typically, every $1 increase in oil prices translates to about 2 to 3 cents more per gallon at the pump. So sustained gains could really make a dent in your budget. Federal Reserve officials are openly acknowledging this balance of risks calculation, and while some believe the impact of the Iran war on inflation might be temporary, gas prices are a crucial talking point for President Donald Trump's affordability agenda. Lower gas prices recently helped offset rising costs for groceries and housing, providing a much-needed cushion for American consumers. But that cushion, as we've seen, is quickly disappearing. President Trump has attempted to stabilize oil markets by announcing plans for maritime risk insurance and naval escorts through the Strait of Hormuz, but so far those efforts haven't significantly eased market volatility or rising prices. While the president has indicated that a rise in gas prices is secondary to the larger conflict, for policymakers in Washington, the economic stakes are far broader. If inflation starts to climb again, the Federal Reserve might be forced to keep interest rates higher for longer. This means prolonged expensive borrowing costs for everyone, undermining the president's economic message just months before the November elections. And if the economy deteriorates and the labor market seriously weakens at the same time, well, buckle up, because we could be in for a very bumpy and uncertain ride. All eyes, it seems, will continue to be focused squarely on the direction of energy prices. So, what do you think? How will this impact your everyday life? Let us know in the comments below. And if you found this breakdown helpful, please hit that like button, subscribe for more in-depth news analysis, and ring the notification bell so you don't miss our next update. Thanks for watching.